The subprime crisis begins. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, Goldman Sachs finds themselves at the epicenter of the subprime crisis. Now, keep in mind, they were the same bank that made a killing in 2008 on subprime, and now it's coming back to haunt them. I want to show you how the mainstream media is brushing over what's going on at Goldman, saying there's no big deal, but when we get into the details, you're going to find out that this is a serious issue that's starting with Goldman and is likely to leak into the other banks. Plus, many of you have been asking, are the other banks going to be safe? What is the catalyst that could bring down the small and mid-sized banks? Well, we've got some new data on that, on what I think could be the catalyst, and that's the used car market. We'll give an update on that. Plus, we've got a sponsor for today's show. I'm going to give you 6 reasons you might want to add this stock to your portfolio and a chart setup that will absolutely blow you away. Stay tuned to the end for more. For now, let's head over to the Wall Street Journal and pick up our head story. Goldman Sachs profit plummets from deal-making drought. Again, I want you to see kind of what's going on with the headline news. They're saying, look, their quarterly profit was down $1.33 billion, 66% from a year ago, which is staggering. And here they say quarterly profit down 66% from a year ago, revenue down a whopping $10.59 billion or 16% from a year ago. Let's dig a little deeper, because here you're going to see how they're going to brush it over at the Wall Street Journal. They note that Morgan Stanley reported a 40% drop in profit on Tuesday. Look at this, the key here, investment banking revenue. Goldman's investment bankers took in $1.87 billion in fees from fourth quarter, 48% than a year ago. Again, back to that investment banking theme. And Goldman is more reliant on deal fees than peers like JP Morgan Chase and Bank of America, both of which have big consumer banking arms. And here we see the banks all set aside more money for potential loan losses, a sign they're prepping for an economic downturn. So far, we get one little sentence from the Wall Street Journal here that kind of suggested, well, maybe there's a problem, but really the issue here is just all focused on this investment banking issue, even though it is not really the big issue that's the problem here. When we're looking for subprime problems, the investment banking arm is not going to show it. But now let's head over to Bloomberg and see if they can find the real story. Goldman expenses surge on pay at the pain of shrinking revenue. Widely expected to be awful, Goldman Sachs Q4 results were even more miserable than anticipated. The real problem lies in the fact that operating expenses shot up 11% while revenues tumbled. This strongly suggests more cost-cutting and layoffs are to come. So here we have one news source saying, I want you to see is the investment banking division is the problem. Now we switch over to Bloomberg, and what do you start to see? Oh, well, they just have too many high-priced employees. The question is, which is it? Fourth quarter compensation costs of $3.8 billion were 16% higher than the same period last year, though the gauge dropped on a full year basis. That indicates the bank's leadership was too conservative with its compensation set aside in the first 9 months of 2022. Managers will still have to deliver a tough bonus message to its bankers and traders this week. So is the real issue, if we're kind of looking for the subprime problem, so far we've got the investment banking division, which has nothing to do with subprime, and then we've got, of course, wages, again, nothing really to do with it. So I want to look at what this wage issue is, because we see this happen when you have a long expansion, or in this case, a buildup of fiscal and monetary stimulus, and then a pullback in the economy. Now, I'm going to look at a couple charts with you, and these are not specifically to Goldman or the banking industry. We're going to step back and look at the big picture of the economy here, and let's take a look at why we should expect to see wages come down, but not actually contract. Here we have current new orders. We're going to go to the Philly Fed now, the regional Fed survey in blue, and look at new order growth. And the reason we like the Philly Fed data is because, well, we've got a lot of it going back to the 1960s. And against that, we have average hourly earnings of production and non-supervisory employees. So again, not related to bank employees, but I just wanted to show you what typically happens is when you see new order growth come down and that blue line falling, particularly below the horizontal black line, it's telling you the economy and demand is coming down. Now, what you would expect and do see is wage growth starts to slow down. So you see the red line start to head lower. Now, I want you to note, though, it's you see this 0% here. Well, that means wages aren't contracting. It's just wage growth is slowing down to, say, around 2% a year. But it's pretty normal that in the late stage of an expansion, you see wages rising, and then you see them slowing down here. So as we dig a little bit deeper, of course, we see note that Goldman mentions, perhaps, at least in the articles, there's going to be layoffs because compensation is too high. Now, if you wonder why wages don't contract, well, there's a really simple answer: because people that lose their jobs, well, their wages don't get counted. So here's what we can see now, taking the same chart and overlaying the 4-week moving average of initial claims. And what we should expect and do see is that as new orders come crashing down, then unemployment claims go up. So what you can note here is, again, blue line goes down, red line goes up of initial claims, is what you see at companies like Goldman, and I think we're going to see in the other parts of the economy, is as demand goes down, they're not going to get rid of their high wage employees specifically. They're going to keep those who are producing, and those people are going to get less of wage growth, whereas the other people are going to lose their job, and of course they're not counted. And now we start to see the catalyst for subprime. So let's dig deeper into this Goldman story, because again, I wanted you to see the setup where the mainstream media just kind of brushes this aside as if it's nothing. The investment banking giant has also poured billions of dollars into his retail effort, and now we get to the story, which includes the Apple Card and specialty lending platform GreenSky. That operation, with posted revenue of $513 million for the quarter, has posted a whopping $3.8 billion in pre-tax losses over the last 3 years. Now, we covered this initially last week, but what we're starting to hear with Goldman, and this is what I'm suggesting to you is going to leak into the other banks, is what Goldman did is they issued a lot of credit to people they probably shouldn't have, or were questionable credit scores, or had questionable work history, or did not have the finances they needed. And what we're starting to see is these people rang up their credit cards because Goldman was happy to throw out all of these to anyone who asked. And now Goldman's find themselves on the other end of the spectrum, where all of a sudden people aren't able to pay. And what we're starting to see is charge-off rates go up. And now we get to the real story. And of course, now we'll head over to Zero Hedge so we can get to the answer. Goldman tumbles after big revenue, EPS miss, and here we go. Notably, this really was one sentence in the Wall Street Journal article not covered in Bloomberg. Loan loss provision soar 183%. And here you can see Goldman reported that its fourth quarter 2022 provision for credit losses surged a whopping 183% to $972 million, reflecting provisions related to the credit card and point of sale loan portfolios, primarily from growth and net charge-offs. Again, this is Goldman saying we're taking the loss, and individual impairments on wholesale loans. So what we're seeing now is the beginning of the subprime crisis. Now, you remember before it was in the housing market, but it was inevitable that we would see it in the consumer space this time. And so the reason I expect this to leak to the other banks, not just because they were increasing their loan loss reserves, which we saw and talked about last week, it's just because the likely path of the economy is we should see in the months to come layoffs start to increase. And of course, those people won't be able to pay on their bills. And yet there's another bill they're not going to be able to pay on, and that's their cars. The steep plunge in used car prices, what it means, and what's ahead. This is from CNN. Data from Edmunds shows the average price of a used car purchase in December at just under $30,000, down nearly $1,600 from the record high. Today's average used car price is about the same as it was the average new car prices recently as 2010. While prices of late model used cars are down only 5% off their peak, according to Edmunds, the price of older used cars, those 5 years and older, some of them which likely have loans on them, have fallen 15% or more from their peaks in 2022. Now you start to think about which banks have a lot of car loans. Well, you're going to look to your small and mid-sized community credit unions, local banks. They have a ton of these things. One of the things that I keep asking is, will their parking lot turn into a used car lot? Let's dig a little deeper here. because there could be more declines in the used car prices in the months ahead as new car inventories continue to build. One thing that could have put a floor on the used car prices, late model used cars will likely be in short supply given the reduced new car production over the past 3 years. But of course, we know production on new cars is starting to pick up. They're getting the chips in that they needed to produce more, and we're seeing demand go down. So now what you're seeing at Goldman is just the tip of the iceberg. People aren't able to pay on their credit cards. The banks are taking charge-offs. They're increasing their loan loss provisions. But when the layoffs start to hit, and they will likely come again sometime early this year in the months to come, barring an economic turnaround, what you will see is people will face a decision of, do we want to make payment on rent, food, energy, car? The car will go, and I'll tell you why. It's because they're upside down, and that's where you're going to see the banks really start to hemorrhage. And now let's talk about our sponsor of today's show, Siyata Mobile, and this is an interesting company. I want to show you here. Here's their chart. There's their chart. This is their website. Again, Siyata Mobile, symbol SYTA, and there really was a neat company here because they're a leader in business-to-business global vendor, the next generation push to talk over cellular devices and cellular booster services. And it's got a portfolio of in-vehicle and rugged devices that enable first responders and enterprise workers to get this instantly communicate over a nationwide cellular network of choice to increase situational awareness and save lives. And so you can imagine that this technology is going to be in hot demand because rather than picking up and calling people, they can have instant communication. Think of it like a national service, like a walkie-talkie that works anywhere, instant communication. Siyata Mobile is one of the leaders in this technology, and they're poised to make a big push and make a big splash. So in the description and in the pinned comment, you can see all the details here that we're going to go through, but wait till you see the chart. It's going to blow you away completely. Let's talk about their channel partners with a combined existing base of 343 million subscribers. They've got AT&T and Verizon as channel partners. Could you imagine when they roll out their game-changing push to talk over cellular devices where their stock price could possibly go? Well, Thomas Kerr, a CFA and senior equity research analyst at Sachs, he says that this thing can go way higher and has put a $2.50 valuation on Siyata Mobile. Again, symbol SYTA is currently trading around 21 to 22 cents as of the recording of the show. So talking about a massive upside potential. It's also got massive bounce potential. They note that it recently bounced off its 52-week low. Again, that was just under 11 cents. As now, as I said, is trading around 21 to 22 cents a share. And this thing could make a massive move if it got back to its 52-week high of $5.47. You're talking an outrageous return of not quite, because this was published. This research was published at a price slightly below its current level, but you're talking massive upside potential in the stock price here. And if shares trend above its first line of resistance at 14 cents, which it did, it broke its 50-day moving average. If it gets to its 200-day moving average, and we're going to look at a chart here in a little moment, it's going to blow you away. But make no mistake, if this thing is able to climb from its February 8th, 2022 opening price of 13.8 cents back to its 52-week high of $5.47, we're talking over a 5,000% move here. And now let's take a look at the charts, because this is really going to blow you away. There's a massive amount of support under this chart, and you can get the idea of why this is poised to go higher. And if there's a major announcement about their technology being used, you can just get the picture of how this stock could skyrocket. So here, let's take a look at Siyata Mobile. Again, SYTA. Here's their chart looking back over the last 6 months, trading, like I said, around 21 to 22 cents a share as of record. But now when we go and overlay the 6-month volume profile, and what do we see here? There's a massive amount of buying right under here. And we're going to zoom in a little bit, but what this does is it puts support underneath the stock. And you notice there's not much trading volume above it, suggesting that if it could break out of this range here, the stock could just surge higher. And as we zoom into the 90-day chart, what do we see? Look at where all the buying is coming in. You see right at these levels at 15 cents, massive amount of support building up here. And what you're looking at is a potential massive move higher in the stock. And so one thing we love to see is, again, volume profile below the purchase price if you're looking to add this to your portfolio. And when you see a massive amount of support going over the last 90 days, it tells you there's a lot of buyers there, and it looks like they're holding. And the reason they would hold on to this is because the growth trajectory for Siyata Mobile has potentially huge. In general, nano-cap companies have market caps of less of 50 million. And by identifying companies when they're small, you have the opportunity to witness the front end of a massive growth curve, according to MarketWatch. And they have robust revenue growth as well. Again, you talk about why people are adding positions in this company. They reported a third quarter 2022 results on November 10th, which demonstrates strong growth for one of its product lines. Revenues for the quarter ending September 30, 2022 were $2.567 million compared to $1.218 million in the third quarter of 2021, marking a 111% increase, and that came from the sale of rugged devices, including the SD7 rugged handset during the quarter. And so they're a market disruptor, and that's why we like Siyata Mobile here, because they're a small size. There's no other competitor that offers as comprehensive a portfolio of products as they do, and they've got their large global telecommunications customers available to provide potential rapid entry into this market. So you can only imagine what would happen when they're pushed to top technology. Should it get adopted by AT&T and Verizon, it would just go like wildfire, and that would put a big boost under their stock price. And now you start to get a picture of perhaps why over the last 90 days there's been some buying under there, a lot of buying and a ton of support. If you want to access the research reports, check the description below. There's a link to that and in the pinned tweet so you can follow along with the research. For those who are asking, I no longer can disclose if I'm taking a position until we get some of our firm disclosures rewritten. And in the meantime, we're also still working on a back-end system where you can come in, a portal where you can access and get more research on companies like Siyata Mobile as we cover them and follow them. So stay tuned for that. But in the meantime, check out SYTA. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.